The law of unintended consequences for the Fed, for Biden, and for India. This is Wall Street Week. I'm Romaine Bostic, in for David Weston. This week, the geopolitical winds blowing in India's favor. A conversation with Rockefeller International Chairman Ruchir Sharma on Narendra Modi's economic ambitions.
You'd have to be a very big contrarian to take a bet against India.
Plus, the business of sports with Boston Celtics co-owner Steve Pagliuca and the high-stakes deal-making in basketball and soccer.
A lot of these valuations have been driven up by the fact that certainly basketball and soccer are global games.
And HPE CEO Antonio Neri on the rush to strike while the AI iron is hot.
AI will be a huge boost of revenue growth.
It was a compressed trading week in U.S. markets that for a second week in a row orbited around one Jay Powell. The Fed chair making a semi-annual pilgrimage to Congress, 2 days of questioning before the House and the Senate on the outlook for interest rates.
It only makes common sense to move at a careful pace. We don't want to do more than we have to, but overwhelmingly people on the committee do think that there's more rate hikes coming.
Lawmakers also pressed Powell to explain how the Fed will strengthen the supervision and regulation of our banks.
We need to update our thinking around liquidity regulation, which was based on a certain speed of bank runs, which now looks to be outdated. Really, the liquidity regulation was just not appropriate.
The rise in interest rates and the regional bank fallout have already had considerable consequence for the housing market. The number of homes for sale in the U.S. dropping to a record low. Homeowners opting to stay put since moving would mean giving up a cheaper mortgage.
Those that have that 3%, 4% mortgage are going to be very reluctant to give up that interest rate. They have equity in their home, they have equity in their mortgage.
Then there are the consequences of high inflation. Central bankers around the globe this week making clear that the battle to curb price pressures far from over. Fresh rate hikes from Switzerland, Norway, Turkey, and the UK. The Bank of England unexpectedly boosting its benchmark rate by a half percentage point a day after core inflation unexpectedly surged to a 31-year high.
Well, today's figures strengthen the case for the government to stick to its guns. No matter what the pressure from left, right, or centre, we won't be pushed off course.
Meanwhile, the consequence of a single word. The week started with U.S. Secretary of State Antony Blinken making progress on thawing relations with China, but by the end of the week, that progress was undone. An unscripted comment from President Biden at a campaign event referring to Xi Jinping as, quote, a dictator.
We had an incident that caused some confusion, you might say, but Secretary Blinken had a great trip to China. I expect to be meeting with President Xi sometime in the near term, and I don't think it's had any real consequence.
And the consequence for poor U.S.-China relations. It's looking to be advantageous for India. Prime Minister Modi, in his first official state visit to the U.S., making the case for corporate CEOs and government officials to view India as a partner in technology and a counterbalance to China.
In the past few years, there have been many advances in AI. At the same time, there have been even more momentous development in another AI, America and India.
Meanwhile, back on Wall Street, global stocks notching their worst week since March. The S&P and the NASDAQ down more than 1% on the week. The Stock 600 Europe sliding 3, and the world-beating Nikkei in Japan ending a run of 10 straight weeks of gains. The money flowing out of equities did find its way into the perceived safety of government bonds, and that did push yields lower, deepening the inversion of the Treasury yield curve. And that, in turn, prompted a flight into the dollar and a flight out of commodities. It was a somewhat confusing and chaotic week for financial markets that have been on an unexpected rally this year in defiance of mixed economic data and hawkish central bank actions. Investors now left to decide what's worse, the fear of missing out or fear of the next shoe to drop. Joining us now for our roundtable is Chris Ailman, the Chief Investment Officer over at CalSTRS, and Sarah Ketterer, the co-founder over at Causeway Capital. And Sarah, this is a question that I think is going to be debated for weeks, if not months to come here. Looking at this rally that we've had so far this year, do you think that whatever tailwinds caused that rally will persist into the second half of the year?
Romaine, I hate to be so so sobering on a Friday, but probably not. And for some of the reasons that you've opened the show with today, the economic situation is likely to slow. Certainly overseas, Europe's already slowing. UK has a terrible inflation problem, is doing its best to contain it. And as for the US, I mean, even more inverted yield curve, plus the fastest Fed funds rate rise up to 5 percentage points that we've seen in I don't know how long. What's going on in credit and tightening of credit? I mean, there are numerous reasons why the stock market in the U.S. and overseas may have gotten ahead of themselves. It doesn't mean to say there aren't stocks to own.
Right.
It's just the broad indices might have a bit of a setback ahead.
Well, I am curious, Chris, about that here, because remember, this was kind of the discussion heading into this year. That was the surprise that those worst case scenarios didn't materialize. But we started to see a lot of softness in the economic data. We got global PMIs this week that showed that Europe still in deep contraction, at least in the manufacturing sector. And the U.S. side isn't doing much better either.
But Romaine, despite all that bad news, European stocks are near their all-time high. U.S. stocks are near their all-time high. Look, my fiscal year end is June 30, so I am getting right to the finish line. I just want to keep going at least another week before, as Sarah said, kind of the reality sets into this market. Romaine, we have been predicting a recession since almost last summer. And yet here we are again. I'm going to tell you, there's likely a recession somewhere in the next 2 quarters. Yet this market defies gravity and keeps climbing. So this last week was a rough week. Mm-hmm. But hey, after such a run for 5 weeks, it's got to stop and catch its breath. The question, I think, as Sarah is saying, what is the future? It's about earnings. And there's a lot of headwinds that would say we should slow.
Well, Chris, let's talk about earnings here. We're about 3 weeks or so before we get the start of the fresh earnings season. And there is concern here that maybe some of the resiliency we saw over the last couple of quarters, the quarterly reporting seasons, that might not necessarily hold up when we get the results in mid-July and through August.
Romaine, I was surprised at that resiliency, but it came from this, the incredible stimulus during COVID, and it has hung on for a whole year, kind of beyond COVID. I mean, it's still with us, but the reality is we have been all shocked at how strong the consumer is, the employment numbers, the fact that, jobless claims was flat and steady this time is maybe a sign that we're going to start to see a buildup of unemployment. Mm-hmm. I've got to listen to Powell, what he said during his testimony, that he's willing to sacrifice employment and economic growth to kill inflation.
Well, Sarah, what does that mean, though, for investment allocation? We know, at least in the equity space, particularly here in the U.S., tech stocks, and particularly we talk about software and semiconductors, really led this rally here. Is there a case to be made to be exposed to other sectors?
There is probably more defensive. We've added a considerable amount of consumer staples as a place to get both income and stability. Those low beta stocks could be very useful in the next 6 months plus. It's hard to predict timing, but I'm on the same page as Chris. I'd add to that is it's not just earnings, there's liquidity too. And liquidity should be draining out of the monetary system globally, with the exception of China. So the Fed is going to take $1 trillion off its balance sheet, supposedly every year for the next couple of years. That's a tremendous headwind. So being a little more defensive, and not to mention the cyclical stocks, as Chris mentioned, have really run. I mean, why have materials and industrials and financials done so well before the recession? It's really extraordinary.
Is that based on, do you think people are buying into the idea of the economic cycle, or is there something different driving that, Sarah?
I just think nobody wants to get left behind. And clearly the big winners year to date have been information technology, communication services, but some of these cyclical areas outside of energy, which is last year's winner, which has been pretty soggy this year, the rest have done surprisingly well. And maybe it's just a disbelief that there will be a recession.
It will be a recession. And Chris, we have to point out, too, when we talk about the rally that we've seen in the equities, this has been truly, indeed, been a global rally. You mentioned, of course, Europe, equity indices camped out near record highs. We, of course, knew last week the Nikkei over in Japan hit a record high. And while U.S. stocks aren't quite back to their record highs, it's still been an impressive turnaround from where we were even just, 6 or 7 months ago.
Romaine, it's been weird. And I mean, in the technical CFA sense, complex idea, it's weird. Seriously, a global rally, when you said that, you're getting weak industrial numbers out of Europe. And on top of that, what a narrow market. I mean, for up until 2 weeks ago, it was 9 stocks. I don't know, Sarah, as an active manager, how you make money in a year where it is so narrow and the breadth in the market is so bad. Over 500 or 250 of the S&P 500 stocks are actually down on the year so far here in 2023. So Romaine, like we own the market, so and we're global. So we've capitalized on the fact that Europe and Japan have done so well and the US has done so well, but I'm leaning defensive as we get into July and across the summer.
All right, in conversation right now with Chris Ailman over at CalSTRS and Sarah Ketterer over at Causeway Capital. A discussion coming up next here about the credit cycle here, the health of banks and what that does and what it feeds through into the economy and into markets. A lot more coverage coming up here on Wall Street Week on Bloomberg. This is Wall Street Week. I'm Romaine Bostic in for David Weston. The KBW Bank Index is falling more than 5% this week amid what Wells Fargo analyst Mike Mayo said is a combination of a bank crisis discount, a recession discount, and a regulatory discount. The results of the Fed stress tests are set to be released next week and could provide some insight into the potential for higher capital requirements for the biggest lenders out there, and insight, of course, into the feed-through into bank lending and economic activity. Chris Ailman of CalSTRS is still with us alongside Sarah Ketterer over at Causeway Capital. And Sarah, there's sort of 2 components here when we talk about the banks, and I guess what we want out of the banks, right? There's that extension of credit, I guess, to the economy, to folks that need to borrow. There's also the issue of capital returns to shareholders.
Yes, and they're a bit in conflict at present in the U.S. U.S. banks, certainly at the regional level, are under quite a bit of pressure. And as long as the rates remain high, they have a serious problem, both their assets and their liabilities, flight of liabilities and markdown in assets. So what are they going to do? I think they just a race against time for them. They've got to hold it all together. We think they're a somewhat unsavory place to be investing at present. And, in contrast, European banks overcapitalized in general and returning capital to shareholders through dividends and share buybacks. That's, it's interesting to see the turn of the tables after all those years of European banks being underperformers versus the U.S. That it has all changed.
Chris, I am curious, when we talk about economic conditions, or at least we try to read the tea leaves of what those economic conditions might be, we do know that, well, having credit, basically banks lending money to consumers and to businesses, is a big part of the grease for our economy here. And there are concerns that grease just isn't there, at least not into the level that we want it to be.
Well, Romaine, I think the banks have really slowed down their corporate lending and their direct lending programs as a result of the regulations that came in 2008. But they're definitely being more conservative. The regional banks hold a lot of real estate debt and office real estate debt. And you guys have talked a lot today about how the real estate market is due for write-downs and declines in value. That's going to put pressure on their balance sheets as in some cases the owners throw the keys at them. So I'm worried, there's still a lot of private credit that has now come in from institutional investors into the market that can fill that financing gap. Those rates of return look pretty attractive now that there really are yields in fixed income. That said, I think the regional banks are going to continue to feel pressure just because their natural market is certainly compressed. They've got better interest rates to help them, but it's going to be tough.
That natural market is compressed right now, Chris. And you mentioned commercial real estate. That's obviously a big focus as well. But then even Jay Powell, when he was on Capitol Hill this week, was asked about the need for additional, or I should say higher capital requirements. And he pretty much, at least in the way that Jay Powell speaks, affirmed that.
He did, Romaine. And I think that, they would like to see stronger, safer banks. We took a lot of time to look deep into Silicon Valley Bank and understand that exposure, First Reserve Bank. They really were outliers when you look at the inflows and outflows to banks, their capital structure. The regional banks, there are some that are weak and some that are strong. The money center banks really are in very good shape in the USA. So I don't think this is a banking crisis. The stress test will be painful for some, but I think the Fed really is trying to watch it closely and keep the banking system supported.
Sarah, you're probably a little bit more of an active manager than what Chris would be. I am curious, does what happened with the banking crisis, the regional banking crisis back in March, and the potential sort of specter of additional regulation, does that change your broader investment thesis overall?
No, it doesn't. We're value managers at Causeway, and our fundamental portfolio is international and global. And no matter where we are in the economic cycle, whether we're in a slowing phase or an expansion, we're looking for companies engaged in operational restructuring. So something has gone wrong with their earnings, and the new management or the reformed management is there to fix it and reaccelerate. And those companies exist all over the world. So the current environment does not, but it doesn't help us when central banks get too accommodative and they take rates down to zero, because then there's no cost of capital. And then using a valuation approach becomes somewhat challenging. And we are beyond that. It's a new era now. So it's very exciting to be involved in valuation work and find that our toils are rewarded.
All right, Sarah, this is a great conversation. Sarah Ketterer over at Causeway Capital, and there on the other side of your screen, Chris Ailman over at CalSTRS, two big and really smart people here to talk about the week that was and maybe the weeks to come up ahead. A lot more coverage coming up here on Wall Street Week on Bloomberg, including a look at turning around a company and winning the NBA Finals. Believe it or not, they actually have a lot in common. A conversation coming up with Steve Pagliuca, the co-owner of the Boston Celtics, and of course, former co-chair over at Bain Capital. He's going to tell us how he applies his private equity background to basketball. That's coming up next on Wall Street Week on Bloomberg. I'm here right now with Stephen Pagliuca, of course, the former co-chairman of Bain Capital and co-owner of the Boston Celtics. We've been talking a lot about the business of sports here, Steve, and probably no business has grown as much, at least not here in the U.S., as the National Basketball Association. The current television broadcast rights set to expire sometime in mid-2025. I know negotiations have already begun, at least with current partners. But there's a lot of speculation right now about how much the NBA will broaden its reach in terms of the TV rights and the TV partners it has.
Well, we're very optimistic. Viewership has never been higher. It's been a fantastic season, great competitive balance, and wonderful playoffs. So things are looking up for the NBA. It's a global game, and we continue to build the business in Africa and overseas. And so really exciting times ahead.
In order to sort of reach a lot of the new folks, as well as even the current crop of fans that you have in the league here, there is some concern here that over the last few years, if you wanted to watch an NBA game, there were really only a couple of places that you can do it. You know that how we watch TV, how we consume media has changed a lot, even over the last 5 years. When you anticipate what a new contract, a new broadcast contract looks like, do you think it's going to be a much wider number of companies involved than what we currently have?
Yes, that's been the trend in the NFL, the trend in all sports, so more people can see more games. Fundamentally, a lot of these valuations have been driven up by the fact that certainly basketball and soccer are global games, and with the streaming capability and the ability to reach millions and millions of customers. You know, we used to measure the fan base in millions, and now it's tens of millions, hundreds of millions, and even billions as far as football goes.
As we see valuations for the popular sports, the soccers of the world, the NBAs of the world, we've also seen investors now start to look at, I guess, what can be considered second-tier sports, whether you're talking about something like lacrosse or even something as what was once obscure like pickleball, at least as a professional sport. Have you taken any interest in that sort of tier of sports leagues?
Yes, PAGS Group Sports, our family office, we've looked at several opportunities. And again, I think sports is compelling programming, and there's going to be a trickle-down effect into all these other leagues. So people will start have the capability of watching lacrosse or watching pickleball because it's compelling programming. So I think you're going to see growth in those ancillary sports.
I am curious about your career in private equity. I know you've stepped away from your main role at Bain Capital earlier this year. There are, I think, personally, some parallels to the growth that we've seen in the private equity space over the last couple of decades and the growth that we've seen in the interest and valuations in sports franchises over that same period of time. Is there a material difference in how you approach what you did at Bain and the companies that you were involved with at Bain and what you're doing now in the world of sports?
It's actually very similar. There's similar dynamics in sports. You need to have a great operation. You want to build a championship team. You have to have fantastic management like we have at the Celtics. So there are a lot of parallels. The great news is there is a tailwind in the growth. And private equity, it's been a misnomer in the past. Maybe 40 years ago, private equity was known for taking out costs. Today, the industry is competitive and really focused on building businesses, and they want to build growth businesses. So it's very similar in that aspect. People want to buy and invest in companies that can grow, and sports is a very growing property throughout the world.
All right, Steve. Well, one of the reasons why we wanted to talk to you specifically on this week is because the National Basketball Association draft was held Thursday here in New York City. There was a lot of discussion about, I guess, who would be picked first. I don't think the discussion really veered too far away from, I guess, the man that everyone thinks is going to be the future of this league. Wembanyama, I think, is what they're calling it right now. What do you make of him? And more importantly, I think what he can mean for the league and what it can mean for new viewership.
Well, the league has been fortunate in that, you know, I've been following it for 40 years now. And we had the Larry Magic, you know, Michael Jordan age. And now there are more stars than ever in the league. So if you look down the list, there are 30, 40, what I'd call transcendent players. And Wembanyama, you know, is going to be amazing. He's one of the most skilled big men we've ever seen. He can do it all, not unlike LeBron when he came in. So high hopes for him to kind of lead the next generation. You got Antetokounmpo out there, and it's only going to be great for the league to have even more stars. But he definitely has all the tools and all the skills to be a transcendent player, and it's going to be exciting to watch him. It's going to be tough to play against him, but exciting to watch him.
Well, let's talk about the Celtics and your the structure of what this team is going to look like over the next year. I guess one of the sort of news that did shock a lot of people over the last couple of days was the trade of one of your star players, Marcus Smart, and the acquisition of, I guess, another star player in Kristaps Porzingis.
Yeah, the toughest thing in sports is, you know, we all love Marcus Smart, but the goal in Boston is to win championships, and to do that, you have to put the best team out there that you possibly can. So our team has studied this, and we needed more strength up front. And Porzingis is a fantastic player that will really add a lot and to our club and allow us to contend for a championship. And Marcus will, you know, be forever remembered here for his leadership and heart. And that's really the toughest thing. I love the Celtics and love sports, but the toughest thing is seeing some of these fantastic players, you know, go to new opportunities. Marcus will make a huge difference down in Memphis, and you know, we wish him well. We thank him for everything that he's done here, and hopefully our team is positioned to contend again and hopefully get a championship. We came very close the last couple of years, and hopefully we can push it over the top.
All right, Steve, really appreciate you taking time for us. Stephen Pagliuca there. He is, of course, the former co-chairman of Bain Capital, co-owner of the Boston Celtics. Coming up, Narendra Modi's high-flying ambitions and a fresh opportunity to sell the world on India's economic future. Rockefeller International's Ruchir Sharma says there's still a long way to go.
India is where China should be, or where China was about 20 years ago or so.
That's next on Wall Street Week on Bloomberg. India is now the world's 5th largest economy, and it has big plans to step out of China's shadow. Prime Minister Narendra Modi addressing Congress in his first official state visit here to the U.S., laying out an economic model for expanding India's manufacturing know-how, welcoming foreign capital, and solidifying his government as a premier partner for the U.S. and its technology companies.
India will be the 3rd largest economy soon.
The World Bank estimates that India's GDP will expand by 6.3% in 2023, outpacing China's 5.6% forecasted growth. That's drawing a lot of attention and a lot of money from foreign investors, a rotation into India, particularly among those worried that China's economic recovery is sputtering and in need of a fiscal boost.
I think the Chinese have a very difficult set of challenges ahead of them. There are very serious financial overhangs.
It's not just India's economic growth that is giving China a run for its money. India has taken away China's title as the most populous country in the world. That's according to estimates by the UN's World Population Dashboard.
Projections indicate that the size of the Chinese population could drop below 1 billion before the end of the century. In India, by contrast, the population is expected to continue growing for several decades.
Its younger population gives it an edge, attracting multinational companies from Goldman Sachs to Rolls-Royce to Rakuten, making India the world's back office. Recent economic data highlighted a rapid service sector expansion that can be attributed to the so-called global capability centers. These GCCs now account for more than 1% of India's GDP.
You have to think about the labor productivity issues in the country because it's already a services-dominated economy in terms of the share of GDP.
Apple is doing its part in heating up competition between India and China. Apple's biggest supplier, Foxconn, it's set to start manufacturing iPhones in India by next year as Apple diversifies away from China.
We've had considerable success and tailwinds in the smartphone segment, and we have increased interest from the likes of Apple and Samsung in expanding and growing here.
Investors appear to be all on board. Rupee-denominated bonds are on track for the longest streak of monthly buying by overseas funds in almost 4 years. The local currency is offering the second best carry returns in Asia this year, and equities have lured almost $10 billion in net foreign inflows this quarter, helping India's $3.4 trillion stock market reclaim its spot as the world's 5th largest.
See, the great thing about India is that with 1.4 billion, you can go into any industry. There's a market domestically.
As it positions itself as a leader on the global stage, India faces challenges at home with the withering scrutiny of Adani Group after a report from Hindenburg Research alleged accounting fraud and stock manipulation.
These things don't happen every so often. They're kind of rare. And our view is that we need to bet a little bit bigger when we do get these outsized opportunities.
India's modernization spree must also confront some significant shortcomings. The country's deadliest rail accident in nearly 3 decades, raising questions about outdated infrastructure.
It is a huge setback. Mind you, the federal elections are just a couple of months ago. They will be next year.
For more, we welcome Ruchir Sharma, the chair of Rockefeller International. Ruchir, great to have you here on the program. You know emerging markets better than anyone, and I'm sure you also know that for years, decades really, investors have really been interested in the promise of India. There is a focus right now, if you will, on that country, on its economy and on its capital markets that seems much different than what that focus had been in the past. What's changed?
Well, I think that this focus you're seeing on the back of Prime Minister Modi's visit here has a lot to do with geography and size. The fact that there is such disenchantment with China, and India is the only country of that kind of size, and now also its economic size has become and made it so relevant.
Are there lessons, though, that Modi can take from Xi Jinping and his move to globalize the Chinese economy and avoid some of the missteps that Xi Jinping made?
Yeah, I think it's quite clear, which is that as far as China is concerned, that if you look at China's development path, it was a fantastic development path. It's only in the last few years that it's got derailed, and it's got derailed because they took on too much debt. It's got derailed because the state there has decided to become much more interventionist, flex its muscle, and because China has, in a way, also been retreating from the world and turning more inward. So what Modi needs to sort of realize today is that India is where China should be, or where China was about 20 years ago or so. It should still be a country that's opening up. It should still be a country that is backing its private sector, and not a country where the state is coming down too heavily on the private sector and curbing the animal spirits of the economy. So I think that's the key distinction between India and China just now, but a lesson that Modi needs to take. And the other big lesson I'll say is one of complacency, right? That when you're being feted this way, the entire world is talking this way about you. There is a tendency of many countries in the world, and even India in the past, of taking it easy or just sort of basking in the glory. And when anyone has anything critical to say, the government shuts it down, thinking that these guys are here to just spoil the party. So I think that they need to be very careful of that. Their expectations out of India are also very high. We were speaking a little bit earlier this week about the unemployment rate in China, specifically among the youth, something over 21%. India isn't that far behind. I think, depending on what numbers you use, somewhere around 17, 18% here. So that's something that has to be addressed. But it's also those same demographics that I think attracts a lot of investors. The idea that they have a younger population relative to China, younger working age population, I should say, relative to China. Yeah, so the potential is huge, right? That this has always been there. But something which, a line that I've always repeated about India is that this is a country that has consistently disappointed the optimists and the pessimists. So the last few years, it has clearly disappointed the pessimists because it's done much better than what the worst forecasts were. Now, I think that we just have to be careful that India doesn't follow its past pattern and disappoint the optimists as well. So I think that this is about expectations, about controlling that, about letting the numbers come through. Because if you look at India today, the amount of foreign investment that India attracts is still quite small as a share of its economy. Look at numbers, such as foreign direct investment. The amount that comes into India is like around 1% of GDP. Now, when China was booming and really sort of growing at a 9-10% clip, it was attracting foreign investment, or foreign direct investment in particular, of close to 4% of GDP. Even today, other emerging markets are attracting foreign investment of around 2-2.5% of GDP. So we need those numbers now to come through after this incredible amount of expectations and also outperformance that we have seen. In order to do that, do they need to sort of, I guess, broaden what's available to invest in? One criticism that I've heard from foreign investors is that the Indian economy, at least in terms of what can be invested in, and they're primarily talking about public markets, is way narrower than what you're going to find in China and even other emerging markets. And you even see that in a market capitalization. $3 trillion stock market compared to mainland China's stock market, which is like 12 or 13 trillion. Yeah, but I think the stock market in India has done very well because, the Indian economy, remember, is also about 3 trillion. So, but if you look at is that where the growth is, the list, meaning the publicly listed companies? Yes. The criticism is that a lot of the companies and industries they want to invest in aren't public yet. So they either feel like they have to find a direct way into those companies or they have to sit on the sidelines until there's a listing. Well, for foreign investors and their track record of doing private investments in India is quite mixed. So I think that the public markets in India have done very well. If you look at the breadth of companies in India and the diversity of the stock market, that's one of the best I know of any country in the world. There are so many sectors represented out there, from manufacturing to healthcare to commodities. It's all there. Technology, obviously, is known. If you look at other emerging markets, they tend to be very concentrated. Brazil has 1 or 2 sectors which make up the market, or even China got so sort of taken up by tech as far as the good performing markets concerned. So I don't think that's an issue as far as India is concerned. What's an issue today is just the fact that the valuations are very high, which is reflective of the fact that expectations are very high out of India, and those need to come through now. We need to see the numbers come through, and you can never have an attitude that where else will the money go? It's got to come to India. Right. I think that attitude can be problematic. So we are all sort of, I think that today you'd have to be a very big contrarian to take a bet against India because the fundamentals do look pretty good as far as India is concerned. But also the fact that expectations and the hype around India is something which is quite unprecedented. So a couple decades ago, I was going through some old news clips. There were all these headlines. India's on the cusp. The world needs a new economic powerhouse. These are all stories written about India, 10, 15, 20 years ago here. I'm curious, if we have a chance to sit down, God willing, in 10, 20 years from now, are we still going to be talking about India trying to become the next big thing, or will they already be that big thing then? See, India's story has always been incremental in nature, because if you look at the projections which were done there, in terms of that, India's grown steadily, right? But it's always grown at a rate which is very linked to how the global economy does, how other emerging markets do. So India has grown steadily. It's been an incremental path. What we are now waiting to see is whether there'll be a linear shift in India's growth trajectory. But the issue with, as far as China is concerned and India is concerned, is that the ability of India to carry out massive big bang reforms is quite limited by its political economy. I don't know if because even if you look at Modi, that in terms of if it's come to really dismantling, a lot of the bureaucratic and socialist state, he's been quite tentative about that. So it's not what China did. China, in terms of in its peak boom years, had a massive overhaul of the public sector enterprises. They fired 80, 90 million people or something, in terms of just rationalizing the entire public sector. There's no chance in India you're going to get policies like those because the political backlash will be huge. The DNA is much more socialist. So we have to be, I think, very mindful of the Indian political economy and what the expectations are of us. So I remain, in terms of on my travels to India, quite optimistic, and I remain optimistic because you have so many states in India that are competing with each other to attract more foreign investment. Here we tend to focus a lot more on Modi and what's happening in Delhi. But remember, in India is a very federal society, and you have a lot of states which are doing a lot to attract investment. That makes me quite optimistic about India.
All right, that's a great place to end it. Ruchir, really appreciate you taking time for us.
Thanks, Ron.
Ruchir Sharma, of course, chair of Rockefeller International, a long career at Morgan Stanley, and now, of course, the founder over at Breakout Capital. Coming up, AI gets another champion. Hewlett-Packard Enterprise CEO Antonio Neri on how HPE fits into the competition.
AI will be competitive too, but we always start from the customer point of view.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm Romain Bostic for David Weston. This week, HPE pushed deeper into the AI fray, an announcement of a cloud service designed to handle the large computing power needed to support generative artificial intelligence. I had a chance to sit down with Antonio Neri, the CEO, about HPE's long transition away from hardware to the cloud and now to AI.
The announcement we made yesterday in AI completes our vision and the execution of the strategy we have been through over the last 4 to 5 years, which GreenLake is our cloud platform where we offer edge services, hybrid cloud services, and now we're going to offer AI services. So in many ways complete the entire portfolio, because in 2018 I stated that the enterprise of the future will be edge-centric, cloud-enabled, and data-driven. And obviously AI is an accelerator of that data-driven strategy, and we made available an amazing set of services yesterday, with the leading service being the AI cloud, meaning a public offer, so customers can come and privately train their AI models in the most sustainable infrastructure.
Well, let's talk about shareholder value. What are we looking at in terms of the addition to growth, whether it's profitability or revenue?
Obviously, AI will be a huge boost of revenue growth, and we talked about this in the Q2 earnings, where we specifically call out in 90 days, just in Q2, we booked an incremental $800 million just for this type of AI workloads. Since then, our pipeline has grown now to over $3 billion. And so this is where you see the momentum accelerating. The reason why they're coming to us is because they know we have the capabilities, but also we have the trust. Trust is everything when it comes down to AI. And to build trust, you need to have model completion. And to have model completion, you need to have this capability. So we expect this business to continue to grow and drive profitable growth for our shareholders.
Well, as you seek to get a little bit more traction on this, particularly when it comes to revenue growth, is that going to be enough, Antonio, to make up for some of the lag that we've been seeing in the compute segment?
No, listen, last year the compute business grew double digits, and we drove an amazing profitability. And we know compute tends to be cyclical, There are periods of times where you modernize and you add compute capacity, depending on where you want to host the workloads.
Right.
And there will be periods that will go through digestion. But remember, GreenLake is an accelerator of our compute demand, because ultimately that compute demand stays there for a longer period of time with higher gross margin and honestly higher attach rate. So that's why we are growing the edge, we are growing the hybrid cloud, and now we're going to grow the AI together with the data. And compute will continue to be a very important aspect of our portfolio, but over time, the portfolio mix is going to go to those line of businesses just mentioned.
That was HPE CEO Antonio Neri. AI is attracting attention across sectors, ranging from education to healthcare. But while the use of the nascent technology might vary, the concerns are similar. Some even characterize AI as an existential threat. I sat down with Nara Logics CEO Jana Eggers a little bit earlier to ask her about where AI is headed.
In most people's opinion, they think of AI as, when is it going to be like the human? I think we're very, very far from that. But where we are, which is exciting, is we're at a point where AI can really augment humans and help us out. And you're seeing that with ChatGPT and some of the excitement that people have around the things that it's able to do for them as far as generating ideas, maybe for a vacation or for a new marketing campaign, that it's coming up with different ways than they were thinking.
I was speaking with the CEO of Hewlett-Packard Enterprise. They just had a big splashy rollout this week of some new AI tools that they're integrating really into their larger cloud and enterprise software products here. You advise a lot of companies, you deal with a lot of companies that are looking to build out into this space. Is there sort of a scale-up factor here that you think is viable, particularly when it comes to software and a lot of cloud services?
Well, I typically actually advise companies to scale back rather than scale out. Most companies aren't going to use something like ChatGPT for their business unless it's and HPE has an offering there, unless it's really focused on their business. So they're training models not to be the whole web of information, but to be their corporate information. And I do think that's really important. And so I wouldn't, obviously their use cases will scale out, but I think the data itself scales back, even though, again, things like ChatGPT give us those ideas of what could be done.
We have to talk a little bit here about some of the risk, or at least the perceived risk of this. This week, Bloomberg Technology held a big AI summit. They had a sit down with the OpenAI co-founder. And there was a little bit of a pushback here to some of the, I guess, worst case scenarios that have been posited about what AI ends up being for us, for humanity.
So I'm again excited that consumers are able to use it because they start seeing more of what's wrong with it. And because of that, I think they'll learn a bit more about AI and start questioning, which I think is terrific. I think, some of those fears, I'm more worried about AI hype than I am actually worried about AI itself. So people start believing that it's something that it's not. That's what worries me. And so I am more excited where people can use it, understand that there's some hype around it, and then they can start questioning it more and demanding things like transparency and explainability, so that we know what data is used, how it's used, and what data was actually led to this suggestion or this information, and whether it was created or not. I mean, you've seen some examples of ChatGPT making up, and people call it hallucinating, citations. So if I know that actually didn't come from a real site, I should be able to see that. So ChatGPT should tell me that, as an example.
Well, that gets to this whole idea of just how reliable the use of this can be. Also, it raises a lot of questions about bias. The idea that the ChatGPT or whatever other generative AI products you're using, the output is only going to be as good or as qualitative as the inputs.
Right. And I'd even say, if you have, you may have some really good data, but the question is it good for that use case? So people understanding, I always talk about AI as really three parts. First part is the data, second part is the algorithm, and the third part is the objective. So making sure that those are all aligned, and that this is good data for that use case and of the right size. Again, you may not need the whole internet of information. You may just need your corporate information to actually give you better answers than what the whole internet would give. And then, back to my point about transparency and explainability, being able to understand which data from which data set or which aggregation of data sets really drove that answer is actually quite important now and becoming more important.
As we go down this path, and this does appear to be kind of the future in some form or another, there's been a lot of discussions about the data itself, the ownership of that data. We know, at least with some of these consumer products, if you're just scraping the web, the question is, do you have a right to use something that someone else produced without their permission and, more importantly, without compensation? How do you sort of reconcile that given the large data needs that are required for this?
Yeah, I am actually very much in the protect people's copyrights and really respect their data. This is why when I talk about corporations, them going with their own data, when our customers come to us and say, hey, can you also help us find data? I always push back and say, let's start with your data first. Maybe we'll need that eventually, but let's start with your data first, because most corporations have plenty of data. They don't need to go outside of their corporate walls to do well with data. So that to me, the amount of data is a red herring.
That was Nara Logics CEO Jana Eggers. Coming up, one of the biggest causes of inflation appears to be easing. Supply chains are normalizing, but not for everyone. That's next on Wall Street Week on Bloomberg. Finally, one more thought. In a world where every economic data point matters, a collection of economic data offering some hope for our supply chains. The pandemic disrupted the flow of goods across the globe, leading to shortages of computer chips, months-long waits for furniture delivery, and the mysterious scarcity of essentials like toilet paper.
I would also say that almost all of us have underestimated the dramatic impact of this outbreak. I mean, if you would have asked most people 8 or 9 months ago if you would ever see the kind of impact that we're seeing around the world right now, few would have gotten it right.
But an S&P Global Supply Chain Volatility Index that tracks demand conditions, transport costs, inventories, and backlogs, it shows that after more than 3 years, supply chains are actually back to some semblance of normality. In fact, the index suggests suppliers around the world now have the greatest level of spare capacity since the height of the COVID pandemic. Other barometers of supply chain pain, including from the New York Fed, are showing significant contraction. That's a good thing. U.S. shipments of empty corrugated boxes down 11% from a year earlier. And data this week from Freightos, it shows that the price to move a 40-foot container across the ocean from China to California is roughly a tenth of what it cost just a year ago.
China is America's factory. I'll leave the politics and policy to the experts like Secretary Blinken, but on the ground, business to business, these two trading partners are inextricably linked and count on each other for quite a bit.
But the tide, it may have turned a bit too late for Instant Pot. The modern spin on the pressure cooker was all the rage at the onset of the pandemic, but its popularity ultimately stretched wait times for customers and drove up the cost of goods for the company as well. A spiral of disruption of which the company never managed to break free. The parent company of Instant Pot, it filed for bankruptcy protection this month, citing the high costs of keeping its supply chain running. If you manage to get your hands on one of them over the pandemic, well, consider yourself lucky. That does it for this episode of Wall Street Week. I'm Romaine Bostick. This is Bloomberg.